Okay, this is the Order Flow Trading Course, Lesson 15, Order Flow Trade Setups. My name is Michael Valtos. I'm the founder of orderflows.com. Quickly, let me read through a quick disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 state hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading in programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, order flow trade setups. Why is it important to have trade setups to follow? Because it keeps you out of the market when there's no reason to be in the market. A trade setup identifies the market state prior to a movement in price. Ideally, when a setup occurs, the market should move in your direction almost immediately, but sometimes it takes a bit to get there. The important point is you don't want to trade when you don't have a reason. Having trade setups to follow will help you get into the market when there's a reason to be getting into the market. You don't want to get into the market on a feeling or, you think it's going to go up. You should have something defined, a set of, I'll say rules, but, reasons to get into the market rather than you think it's going up or you heard a story it's going to go up. You want to have a reason to be getting into the market. The setups that you'll see here in this course allow you to have tight stops if you want. Having a trade setup is one thing, but, it has to make sense from a risk management. You don't want to just get into a trade and, not have a tight stop in the sense that you're going to risk, 20% of your account on one trade. That doesn't make sense. You should try to minimize the amount of risk in each trade. So by having good setups, you'll have tight stops. Trading is about finding a rhythm, like being a musician. The market is your instrument and you are playing it. So, you're going to be watching the market, seeing how, it goes up, it goes down. Then there's going to be times when you have your setups, and that's when you're going to trade. I should probably change that. Don't think of it as a musician. Think of it as the conductor of an orchestra. There's going to be times when, some other instrument is playing, then it comes to your part, then you start playing in that sense. But by being able to read the market, you're going to understand it more, and, when it's your time to step up to the plate and participate, you won't hesitate. By having setups, it will allow you to, I'll say, be a bit more relaxed. You're not necessarily having to analyze every single number that comes through. And, it just make your life a lot easier. So a trader needs setups to look for and follow that support the trading style. Do you like to take a lot of trades? Do you like to take lesser trades? Do you have an appetite for risk? You should have trade setups that mimic, the way you can trade. Because, if you're going to be trading, but you can't handle the constant, price fluctuations, then, it's going to be hard for you to trade, any particular type of setup. So, if you're a long-term trader, that's one thing. But, if you're on a short-term time frame and, every tick you're living and dying by, it's going to be hard if you're trying to take setups on a long-term time frame because you're living and dying by every tick. So in that case, you're better off just taking, more of a shorter-term approach to the market. So having setups to follow allow you to have legitimate reasons to take a trade. Having setups to follow allow you to take the emotion out of trading decisions. Should I take the trade or not syndrome. People sit there and they freeze sometimes because they're not exactly sure if they should be taking the trade. If you have setups, it should be it should be a lot clearer to you whether or not you want to take the trade or whether you just want to sit on the sidelines. It's like, people that play sports, there is a certain, there are patterns that you want to, I'll say patterns, but there are plays that you refer to. You're sort of bread and butter on how you're going to score. And the more you score, the more you win. Think of trading in the same way. If you've ever watched a basketball game, you see, they play, the whole game, and literally the last 2 minutes is when the game is decided. And, it's one of those things where, in the last 30 seconds, the teams are calling timeouts to go over the plays they want to run. Now, in trading, with the markets open, you can't call timeouts. That's why you have to have setups that, you can go to when they're appearing. When they call the timeout in the basketball game, they draw up the game plan based on, how the defense is going to appear. So, they're going to come out and they're going to take a look at it, and okay, if that's how everyone's lined up, then we'll go with that play. Instead, in trading, you don't have the luxury of calling a timeout, so you have to have setups in your head, that you're going to follow, that you can go to, when the situation presents itself, when the market lines up in a certain formation, that's when you want to take your setups. It said, sports is always a great analogy for trading. Basketball, they call timeouts, they go over their trade, they're not trade plans, but, they go up over their setups and on what play they're going to run. Football the same way. Baseball, not so much, but, soccer, they understand how they want to play, how they want to pass the ball, and, who they want to avoid in the field. And trading is the same way. Now, a setup can either succeed or fail. A setup should also allow you to determine where to place your stop. You can have tight stops. People don't understand that. They think that you have to have a wide stop sometimes just because the market needs to breathe. Not really. If a trade is going to work, it should really start working in your favor pretty quick. If it's not going to work in your favor pretty quick, it's got a higher chance of failure. That's not to say that, just have a tight stop just because, if it doesn't work out right away, then you'll be stopped out. There has to be a logic behind your stop. You're sort of hiding behind a level you think is going to hold. I'm not a big person on one to say, oh, you have to have a certain fixed dollar amount. I think that's, it's good that you're using a stop, but to think that it has to be a fixed amount, I think is a flawed strategy. If you get into a trade based on a setup and it goes sideways, you can decide if you want to get out early, because ideally a trade should start going in your favor. If it doesn't, there's a higher chance it will fail. What I mean is, as soon as you get in, the market oftentimes will move into your favor pretty quick, but it should move, in the direction of your profit target rather than just sort of, going a couple ticks in your favor, stopping, going a couple ticks against you, sort of going back and forth. If you notice the trade sort of going nowhere fast, in the sense that it's just going sideways for the next 5 or 10 minutes, where's the move? You got into a trade for a reason. Why hasn't it followed through? If you're waiting for an hour for the trade to start to move, a lot of other factors have come into the market, and, the whole supply and demand ideas could have changed. So, I always look for a trade to start going in my favor right away, or at least, within the first few minutes. I know that it's going to trade back and forth, and, but it's just one of those things where if it's just not going the way you anticipated, just get out, save your money, save your bullets, so to speak, for the time when it's going to reappear, and it will work and go in your favor, rather than just sort of spinning and sort of eating up your time and, say eating up your money if it's, a small profit, but, it does take a toll on you mentally. Maybe you're caught up in a trade and, if you follow 2 or 3 markets, you're not necessarily concentrating on the other markets just because you're spending all your time focusing on a market and it's going nowhere. So there are basically 2 types of setups. There's reversals and continuation. Reversal setups generally occur at the end of a major and minor trends. Continuation setups occur after a reversal and during trends. Which is better? I don't think one is better than the other. They both present profit opportunities. I'm not necessarily a reversal style trader where I'm only looking at reversals. I'm happy to identify a trend and jump in and get what I can out of it. That's the whole point of trading. I'm not a big trader anymore. I'm not, the big guy at JP Morgan or someone at Cargill that's got a lot of clout in the market that I can, sort of sit on the market and, and cap it if I want to, or do what, whatever shenanigans, I'll say shenanigans, but, when you've got a lot of money, you've got a lot more leeway. When you're a small trader, retail trader, then, the best you can do is get in, get out with your money. Like I said, I'm not a big macro trader in the sense where I can wait for 2 or 3 months for the big payout. I'd rather be consistent and make money, every day as opposed to, 1 month be up 3%, the next month be down 3%, and just going like that back and forth. But I do think, though, that one of the things you have to do as a trader is decide what type of trader you are. Are you going to be a short-term trader? Are you going to be a, sort of a medium-term to longer-term trader? Are you going to be a long-term trader? It's going to help you, choose your strategy that you want to follow. For many setups, there's I'll say profit limitations because, you have to understand the capacity of moves. If you're going for, short-term reversals, you don't always get the big moves from a high to low. You might get a reversal of a couple of points, 3, 4, 5 points. Continuations, you may get, longer term moves, or you can get, smaller moves. Depends what time frame you're trading. You sort of have to decide what sort of trader you are, how you're going to view the market, and how you're going to trade the market on a daily basis. That's part of, having your trading plan. I don't really discuss having a trading plan in this course, but, have an idea of how you're going to trade. One of the problems is people, they tend to mesh lots of different ways in their trading. Say, I'm going to look at a long-term chart and manage the position on a short-term chart. Well, to me, that sort of doesn't make sense. You're sort of micromanaging it, and in the end, it just hurts you. So, just, decide what sort of trader you're going to be. Can you accept risk? Can you not accept risk? If you have a problem when trades start going against you, you might want to lower your time frame a bit. And if you're trading off of, sort of a longer term chart, 10 minutes, 15-minute charts, but you're worried about every price tick that's going through, maybe you shouldn't be looking at 15-minute charts. If you're looking at 15-minute charts, you should be looking to hold the trade for a couple hours, but if you're looking at a minute chart, then your time frame is shorter, and if you're holding a trade for 15 minutes, then that's already considered a long time. So you have to figure out, determine what type of trader you're going to be, or what type of trader you already are. So I'll cover a few setups, both continuations and reversals that appear every day, but you got to realize not every setup is going to occur every day. And some will occur several times a day. Some won't. Could be days where, this type of setup doesn't, setup 1, for example, doesn't occur for 2 days, and all of a sudden it occurs, twice over the next 2 days. It's a function of the market. And, ideally you like to have a few setups so you have something to trade, but, there may be times where the market just doesn't give you any setups. The market is doing what it's supposed to do. It's, facilitating trade, where buyers and sellers are happy with the price. It's not every day. Usually you get a few trading opportunities a day, but, be prepared that it could be times where, the market is just trading back and forth the way it's supposed to. So setups require your attention to the market to see when they occur. Now, I'm not saying you have to sit there in front of your screen and, monitor every price that comes in. Again, it depends on your time frame of trading. If you're using a short-term chart, like a 5 range chart, then it's going to move very fast, and you got to pay more attention. If you're using a 10 range chart, it may not require as much attention. It still requires your attention, but if you scale it out, if you sort of broaden it out, make it a bit wider, then you could probably start looking at a couple of markets at once as opposed to just one market. But then again, it depends on you and what your capacity is. I mean, some people, I see pictures of people's trading rooms, and they've got like 10 monitors with 50 screens open. Yeah, I think that's more for show than the reality of it. People aren't trading 50 different markets at once. Even the big hedge funds that are into global markets, they're trading 30, 40 different futures markets. These guys, they give their brokers, they send them over a spreadsheet of levels to watch because they know they can't watch everything. And, they're going to rely on the broker to help them watch these levels. They want to know if the Nikkei is going to trade, a certain level, give them a call. If Hang Seng is going to trade a certain level, give them a call. DAX is going to hit a certain level, give them a call. Okay, so let's just jump into some setups. I'll give you some examples here. In the later chapters, later lessons, I'll go through reversals and continuation setups, but just give you a quick look-see into the different setups. Okay, this one is E-minis, a 5 range. So it's going to move pretty quick. You can see, each bar is happening, basically 15 to 30 seconds. So you got to be quick. And there's a couple of things that happen here. You've got this buying imbalance, stack buying imbalance, which is, a bullish sign. I didn't like that it came right behind this, this big volume right here, 1327 lots. I was a bit skeptical if we were going to get through this level again, but so I sort of wanted to see it. And all of a sudden we got a big, massive buying imbalance, 3,000. So I was fairly confident that this market would rally. This was actually, honestly, this was sort of one that was just going sideways to a little bit lower. So I was looking for a move up, which he gave me. Again, this is a reversal pattern, and market's going up. You've got a couple of things. You've got two ratios here. A ratio bounds low, indicating a large print up at the top here. You've got a single print here, this one lot, and you got a selling imbalance. Here you got three things, stack selling imbalance, three things going in your favor, to indicate that there's a reversal should happen. Usually you don't get so many things indicating it at once. Sometimes you'll just get the selling imbalance, or you may just get a single print. I said there's no textbook perfect example that happens every time. Again, this is one where the market was sort of going sideways, but starting to give signs that it's going to go lower. You have a small print ratio right here, and then you get a buying imbalance at the high of the bar. So you see, why is there a buying imbalance at the high of the bar and the market's not going lower? It's telling you, the buying imbalance in the market's not going higher. It's telling you that there's no follow through on the buying, and the market sells off a few points. Again, this is E-minis 5 range chart. This green line is the high. I always like to see how the market reacts around the high. We touch the high, touch it again, lesser volume. You have a divergence. There's no ratio. The ratio comes 2 bars later as you sort of go back towards the high again. And what happens? It just comes within a tick of the high and sells off. Okay, this is E-minis again, and some of these, they don't always work out perfectly. You like to have trades that are always going to be working 100%. But we came up to this high, and we hit the high level. You have a divergence. It's a red candle. You came off. You start to come back up towards it. You have another ratio. You get a selling imbalance right after it. I'm looking for the market to really start to sell off. It didn't. It sort of went sideways. Rallied back up towards this single print. Then again, another single print. So it's telling me, price up here is being rejected. Up here at 93.5, and it just sort of hangs around the level without going down. It's one of those things. You like to think that every trade is going to work out perfectly, but there's going to be times where everything sort of lines up nicely, and it just doesn't develop the way right away that you would that you would like it. I said if you're looking to get short somewhere in this bar, or when this imbalance occurs, but then it just goes sideways, and I said at best you could do sometimes is just hope to scratch it or take a small loss. That's trading. I mean, I'd love to show you all 100% winning trades, but there's times where the trades don't always work out. So here's a Bund FGBL. It's a 4-range chart, and again we came up towards the high. It's a doji candlestick. That's why there's no ratios. I tend to treat doji candlesticks as it's kind of neutral in terms of order flow reading. But then what happens? You come up again towards the high, and you have a ratio of 0, which indicates there's a 0 underneath. And what you have also is a buying imbalance. I said, when you see a buying imbalance at the high of a candle that's turned lower, it's telling you that there was there's no more buying interest to take it higher. And also at the same time, there was some decent selling interest up there. So the fact that, we couldn't trade above this level is quite significant, actually. And what happens? The market gets whacked down. You have the 0 here. So, we opened up at 46, 47. A lot of people were buying 47s thinking we're going back up here at the high at 49 and couldn't get there, and we get whacked down. Someone just came in and said, sell it down to 45. And, they hit the bid there at 45, turned it off, and the market just, traded lower. Okay, this is, more of a continuation trade. You can make the argument that, the red line is the low of the day, that, you're trying to pick the low, but, okay. Say you're not necessarily convinced yet, and you want some confirmation that the market is moving in the direction that you want to go. You're starting to see a bunch of single prints. When it pauses, that's when you're going to get in. When you have 3 in a row as far as ratios, then the market pauses. It's telling you, hey, this could be your chance to get in, and then the trend continues back up. Okay, this is Euro stocks. This is kind of a reversal trade. And what do you have? You're working your way up. This is the high of the day, this green line. And right here, you get within 3 ticks of the high, and you have a ratio bounce low indicating some stopping volume. You circle back up towards it. Second time you get there, it trades on much less volume, and then the market just sells off. But, that's one of the reasons why I said earlier, you got to decide what type of trader you're going to be. Are you going to be a long-term trader, short-term trader? Long-term, I don't expect day traders to be long-term traders, but when I talk about it in the sense of order flow, what I'm more referring to is, are you going to be holding a trade for a couple hours, or are you going to want to hold the trade for a few minutes? For me, I tend to find I'm the type of trader, I hate to say hit and run, but, in and out, rather than be in it for a couple hours. That's why you see some of my charts are in the shorter term, 4 range, 5 range charts, 10 range. For me to get, 5 or 10 points out of the Euro stocks, ideally I'd like to get 10 points and above. Usually my initial target is 10 points. That's 100 euros. But trading 5 lots, that's 500 euros. You can do that a couple times a day. That's a few thousand euros. And that's just for the Euro stocks. There's Bunds, there's, S&Ps and bonds also that I'm trading. So, I got 4 different contracts, and, there's plenty of opportunities. I said it just depends on your style of trading. That's why, people may scoff, say, oh, you got 10 ticks out of it, or 5 ticks out of it. But, hey, there's different types of traders out there. Not everybody trades the exact same way. Okay, now this would be a bit of a reversal trade. This was, again, the Euro stocks, and you hit the low, you have a divergence. That's a reversal signal. You have the small print there, single print, actually, as indicating, the lack of selling down here. So we hit the low, and it's a lesser volume than the first time you hit it. Everything's lining up to get long, and then the market goes the way it's supposed to go. It does run up into this area up here where you got the single print and the small print. I'm not too concerned with it at the moment. Like I said, we're starting to move away from the low. The market's going the way I want it. And, even though you have a single print here, you still have a positive delta. I said this 61 ratio of 61 with the big negative delta is, I'll say is worrisome, but it's got my attention. I do want to see how it's going to be in the next bar, but then the next bar it just sort of negates it over the next 2 bars, and the market keeps on going. Sometimes the market doesn't just move in the straight line; it starts to move, goes sideways, and then continues in the direction. Had you been in the trade, earlier down here, and you run into these bars, and you have sort of a wait and see, when you see this bar here with the single print and the ratio of 30 and the buying imbalances, the strong delta. Okay, it's telling you the move is going to continue. So had you gotten scared and gotten out, the fact that you're seeing this bar here at 902, it's telling you no, getting out was not necessarily the best thing to do it now, because we're still going to keep going, and then it just keeps going up. You see, the single print is followed by another small print here ratio. Okay, this is Euro stocks as well, and it's one of those things. I mean, sometimes I say the market is just giving you chances, and this is like grabbing you by the shoulders and shaking your head and saying, "Hey, get short." And what's happened is you come up here to the high, and you have a divergence and you have a ratio. For me, this is just all systems go, just this by itself, because I know I got a negative delta, and when I have a ratio to go with the divergence, I'm very excited. And so I get short, but then it comes back up, it makes a new high by a tick. Okay, usually on a divergence you're trying to pick a high, so if you take out the high, it's usually wrong, but there's oftentimes you see the high taken out by a tick or two, so I generally like to give it 2 to 3 ticks. Usually 3 ticks is I think safer, but at the end of the day it's a little bit more money. And we took out the tick by a high, but you still got more selling coming in. Even though you're making the highs, every time you hit the high, you got negative delta, 700, 700. And so you have divergences. It's telling you that, it's a weak high. You hit the high with the ratio, it's really telling you, hey, you should be getting short, and even if you don't, when you pop up to the high by a tick, and you're still getting divergences with some strong selling come in, then, it's starting to, wave its hands in the air, say, hey, look at me. And then you come off the high, and then you get the ratio with the small print, in single print in this case, and, it's still a negative delta. It's telling you that now it's like grabbed you and said, get short, get short. If you're still not convinced, we circle back up to tick past the single print, and then sell off finally. This is a case where the market is just sort of telling you, hey, I'm giving you an opportunity here. Don't miss it. Really, you should have been getting short somewhere after this initial bar here. And, you could have gotten, whatever, 10 ticks, more or less out of it. But, with the fairly tight stop up in here, ideally I'd like to get short around the point of controls of the signal bar. So, say I'm getting short here at 01, 02, my stop is just up here at 05, 06, taking it down to 90, 91. Whoops. So I just jumped ahead by accident. This is a Euro stock, and again, it's Euro stock. Euro stocks I think is a great market to trade. Especially even no matter where in the world you are, it's a contract that gives you you could trade it if you live in Asia. It opens in the afternoon, 3 or 4 p.m. in the afternoon, depending where you are in Asia. If you're in Singapore, I think it's 4 p.m. Obviously, if you're in Europe, it's open in the morning. If you're in the U.S., it's open in the early morning, but the important thing is that it trades, during the U.S. day session as well, and it moves, it moves similar to how the S&P, in the same direction. But it's, it's a contract that gives you, good opportunities even during the U.S. hours after if you don't necessarily need to be trading S&Ps all the time. But, this is at 11 in the afternoon or 11 in the morning, just before lunchtime in Chicago, and you're getting the same things. same setup. So you come up to the high, you have a divergence, circle back up to that high where you have the single print. Again, you got a divergence. It's telling you, if you're not short off this first bar here, getting short in somewhere in the second bar is the ideal entry, somewhere near this point of control. I mean, to get back up there, you do have to pull back. I mean, there's going to be times where it just sells straight off, but I like it when you circle back to the high and you can't get past that level. I'm using this single print as my resistance, and so if you're not short in this bar, when you see this next bar, you should be getting short for sure somewhere in there or in the following bar, and you get the move lower. Okay, so the next chart is a E-mini chart, and it's a 10 range chart, which I do like to look at 10 range charts because like I said, in minis, I like to get points, not ticks. One tick is $12.50. 1 point is 4 ticks. So it's $50. And I do talk to a lot of traders, and their profit target is 2 or 3 ticks, which is, I don't know. To me, it's almost not worth it. You're going to be like a cardiac kid as far as trading goes, because you're just living and dying by each print. I'd rather get nice moves, and S&Ps is one that you can get nice moves, and sometimes if you're looking at a slightly wider range chart, that's where you're going to get these nice moves. That's why I like to look at a 10 range chart. Although sometimes if the market's slow on a 10 range chart, it's going to be very difficult to get any trading opportunities. But this is one where we come up to this high level. It's a swing high at 1230, and you have a ratio up here indicating a heavy stopping volume at the top of the bar, and the market turned around. I'm not too concerned with the delta being positive at this point because I know there's a lot of volume up at the top of the bar, and it turned around late. So, the bar was green, and it was showing a strong delta as far as positive. Then selling came in late and turned it down. So, seeing this ratio up here, seeing the heavy stopping volume to me, is usually a sign of reversal. It's telling me there's somebody, if it's a sell signal, it's telling me there's a lot of, someone with some very good supply to sell up here and was basically willing to cap the market, and, the market sold off. People say, well, yeah, all the people that bought there are trapped. Well, not really, because, it's 1,200 lots traded there, 650, 500. But, just below it, a few ticks below, you got 1,300, 1,100, 800. So there's plenty of capacity for them to get out. The next bar, you're trading 38,000. So, even if this bar here is 16,000, even if everybody, 16,000 lots are trapped, the next bar they could have got out. But anyway, we came up to this high, and it stopped up here. That's the important thing. You have the ratio. That's why I have these ratios printed. And the market reacted. If you're not yet convinced that this is the high, I want to see what's going to happen in the next bar, especially, on the back of this, you got a big buying imbalance here, you got a small print there. For whatever reason, if you're not convinced with this volume up here, fine. Wait till the next bar. And what you're seeing a strong negative delta, 3,000, on heavy volume in the bar. That will confirm that this is the top for now. And sellers have come in force and are pushing the market lower. And the market went, from 95, 96 here in this bar. If you were convinced that this was the top, 95 to 96, get short, you could easily get down to 91, 90 area. That's 5 points in the S&Ps. So, that's, I don't know. I just find it's much easier to try and get points than try and get ticks. You still have to spend the same amount of energy in your trading. Okay, again, this is a E-mini chart, and it's also a 10 range chart. And there's a couple things here. Okay, what you have down here at this 1059 bar, you have a ratio. You can't see it just off the bottom. It's a ratio of 38. But what's important is it's a blue number. It's telling you, this is, at the bottom of this bar, there's some small prints and, some price rejection down below. And, I like that you have the point of control towards the bottom. Now, if you're not convinced that this is going to be the low of this move down here, the swing low, in the next bar, what do you have? Again, you have a ratio. This time the ratio bounds low, indicating heavy volume at the bottom of the bar, and you have and it just happens to be a selling imbalance, which is a little bit icing on the cake. Later in the bar, there's a buying imbalance at the top end of the bar. So it's you really if, like I said, sometimes the market just says, "Hey, idiot, get long." So if you weren't necessarily convinced in this bar you should have been. And this buying imbalance held as the support. We got down 2 ticks through it, but 1906, we traded all the way up to 1910. But what happens is you come up to this level and you hit sort of the opposite what you have here. You don't have a ratio, but you still have heavy volume, and you have a buying imbalance right at the top. And if you notice, at this level up here, there's heavy volume, and it's capping the market. I use the term capping the market. But, just imagine, everyone's buying it, trying to get it to go higher, but there's sellers up here. There's people sitting on the offer here, sitting on the offer here, sitting on the offer here, and selling into this bid. So all these hungry buyers, that can't get enough are bidding the market, but people are selling it into them. So, if you're long, this is your sign to get short, or get out at least, at the bare minimum, get out. So I'm not usually one to trade, have a position on all the time in the market, where if I'm long, I only get out to get short. Usually I'll get out and sort of assess it. But, getting long off of this bar, and, if you're still not convinced in this next bar, is, as I said, the market is really saying, pulling you aside and say, hey, buy me. But up here it's saying, get out. It might struggle to get past this 1910 level. And the market came off, so, if you're trailing your stop, you would have been stopped out, or, ideally you would have got out at just, instead of getting out at 5 points, you got out at 2 or 3 points. If anything, if say you didn't even have this stuff here before you hit this high, you hit the high, I'm looking for it to get short. So, had you gotten short off this high, like I said, sometimes you want a little bit of confirmation. You have it here in this bar here. We have the single print. We rally back up to it and then sell off again. Okay, it's a 10 range mini chart again. You've got a few things here. Usually when I see a buying imbalance, a stacked buying imbalance, I like to take it in certain areas. I don't necessarily like to take it at the end of a move, but as a move has already happened and you get a buying imbalance, I'd rather have the buying imbalance happen a little bit lower in a move than, after the market's moved 5 points, 10 points. But, so I'm not necessarily too interested in this stacked imbalance. What I'm interested in is up here, where you have the 2 buying imbalances at the top of the bar. It is giving you a ratio, but the numbers involved aren't the greatest. You got to take what the bar is giving you. This is at 8 p.m. in the evening. So, order flows does work, even during the evening session when the market's a bit thinner. But I've talked about, when you see the imbalances at the top of moves, you got to remember the psychology, what's happening in the market. Everyone is buying it, thinking the market's going to go higher. Especially on the back end, you have this buying imbalance here, and you're starting to see another buying imbalance form here. But where's the follow through? In the end, the market turns negative. It's a red candle. You got a couple small selling imbalances towards the bottom, and the market sells off. For me, this arrow, again, this is something that's unique to the order flow trader. It'll draw the arrow to highlight to you when there's these imbalances appearing out of place. It's telling you to get short. I hate to be like an indicator salesman, but, sometimes, I designed a lot of this stuff for me because I do watch multiple markets, and it's just easier to have arrows drawn or triangles drawn or, green zones drawn out, rather than just looking at a footprint chart and trying to see, like I said, I see pictures of people with 10 screens, and each screen you got 4 charts on it, so what are they really watching 40 markets or what? For me, I watch, I've been involved in the markets, and I've been trading electronically since the 90s when it first started. It was still Aurora at the Board of Trade. It was even before it was called Project A. Globex, NYMEX Access. You used to have to go to New York and take a course on just how to use the NYMEX terminal. So when I see a person, with sitting in front of a picture with 20 screens, or 10 screens and a bunch of markets, charts, I really wonder, because I said I've been trading a good part of 20 years at institutional level, and most people don't have 20 screens that they're staring at, or 10 screens that they're staring at. I know at JP Morgan, it was so difficult just to get extra screens added to my trading system. I think I had 6 screens. 2 of them were for the trading system. The other ones were for Bloomberg and email. But, honestly, you don't need 20 screens. But, if you want to have a lot of screens, you're going to need something that's going to, sort of a dummy thing to say, hey, dummy, take a look at this. That's why I have arrows and these zones drawn out. But normally, I don't like it. In the past, I didn't. And for really, if you don't have a way to highlight these setups to you as they're occurring, then you sort of limit yourself in a sense. I know for me, my capacity is probably about 4 or 5 markets at once. Generally I tend to stick to 2 to 3, but because when you're in a position, it does use your mental abilities. It's not like if you have a position in one market, how the other market is trading, you have to have, it's going to weigh on you because you have to think about 2 things at once. I know that sounds silly, like, oh, you can't think of 2 things at once, but, I say if you're long bonds and long S&Ps, so, in general, they should be moving opposite directions, yet you're long both of them. So, just keep little things like that in mind. So, that's the end of this lesson, lesson 15. Just, talking about sort of different types of setups. In the next lesson, I will discuss more in depth on the reversal setups, and the lesson following it, I'll talk about continuation setups. But, I'll just separate them into 2 different lessons. I think it'll be easier to follow. This purpose of this lesson was just to, highlight to you that order flow, there are, different types of setups or different types of scenarios in the market. So thank you, and I'll see you in the next lesson.